So I thought I'd take a few minutes to talk about term life insurance. Nobody likes to talk about the subject because you're talking about your death, basically. I get it. I don't want to die. It's probably going to happen, though. Hopefully, a couple years out. Anyway, so you pass away. I mean, you leave for work. You don't come home. You have a home. You have children sitting there. It's bad enough that they're going to have to go through the grief process. But what about the bills? Who's paying the bills now? Maybe you're not the main breadwinner, but maybe your family has it so that you're split. I don't care if it's the husband or the wife. In the past, hey, you were paying for daycare, but there was two salaries going into that. Not anymore, there's just one. One of the things you can do to protect yourself is what we call mortgage protection, which is really just a term life policy. You just bought a house, you have kids, you have a 20-year or 30-year mortgage, $250,000, you die, who's paying it? Now you're down to one income paying this thing. So what you can do is you can get yourself a term life policy, 20-year term. For a male 30 years old, in good health, $21 to $31 a month. Sounds like a lot. But you may be that same guy drinking a $5 cup of coffee every day, $20 a week, $100 a month. You're willing to spend $100 on a cup of coffee, but you're not willing to spend $30 to protect your family. And by protect, I mean they won't have to move out of the house because they can use the money to pay the mortgage. Or if the mortgage has been paid down, they can use some of the money toward college for the kids, or paying the other bills, or putting it toward those extra daycare costs that are now coming up. When I talk to people, I hear it all the time. Well, I'll be dead, it doesn't matter. That doesn't say a lot about your relationship, does it? All right, okay, maybe you and your wife are having problems, but don't you at least care about your kids? There's different ways to do it. Banks provide it, but like say the coverage decreases as the mortgage comes down, whereas life insurance is set at whatever face value you get. The check is cut to the bank to pay the mortgage off in the event of your death, whereas with life insurance, the check goes to your family tax-free. They can use the money to pay off the mortgage, or like I said, if it's already paid down, they can put that towards other things, kids' college, other bills, maybe I don't know, maybe they just want a vacation to get away. They're grieving as it is. Maybe they just need some time away. There's a couple things to consider. I can walk you through the steps. Again, it's not expensive. Like I said, a 30-year-old man, $20, $30 a month, you're protecting your family in the uneventful death, or eventful death, I should say, that something were to happen to you. And typically for a woman, it's less. So, with today's world, I get it. Two-income families, you need them. So wouldn't you like to know that you've left at least something behind other than your memory to help your family? If you want to, give me a call, 724-209-5578, and let's discuss. Thanks. Have a great day.